If you're planning for retirement, this new tax proposal represents a massive change to a lot of key areas of planning. We're talking about permanent tax cuts, new planning opportunities, and some hidden landmines you'll want to avoid. Whether you're eyeing Roth conversions, early retirement healthcare, or managing a $1 million plus portfolio, this bill affects you. Let's break it down in plain English and show you what some of these changes could mean for your situation. First, the name of this bill, the One Big Beautiful Bill. What a world we live in, right? Based on government bill naming over the last few years, you'd almost have to guess we are being gaslit here. We had the Secure Act, which includes changes that made passing money on to the next generations less secure. We had the CARES Act, which was supposedly aimed at economic relief, but ultimately created more debt and long-term instability. If Congress were more honest, these bills would just be named something like the More Debt Act, because that's all most of us end up seeing as the end product. But I digress. One of the biggest question marks in retirement planning has finally been answered: tax rates. If no changes were made starting next year, we are headed for higher brackets, smaller deductions, and higher overall tax bills for retirees. We're talking 0 to 4% bracket hikes across the board. We've shown this in past videos how this can lead to a situation where your tax bill might go up 10 to 20% just with the current rules ending. Luckily, we are going to have some permanent, not just temporary clarity if this bill passes. But before we get too excited or overhaul our plans, we have to ask the question, will it pass? The bill is moving through budget reconciliation, which basically means that we need a simple majority in both the House and the Senate. As an update, this week it just passed the House by 1 vote. Now, normally in a normal bill that includes tax cuts and significant budget changes, there would need to be a vote of 60 senators agreeing on the bill. Again, here we just need a majority. That's good news for speed, but it comes with some strings attached. This bill must not increase the federal deficit beyond 10 years, but here's the catch. This bill includes massive tax cuts with only modest spending cuts to offset it. So while I give it a 70 to 80% chance that the major tax provisions make it through, there will almost certainly be some changes. The positive, it's targeting a summer passage. This gives retirees much more time to plan, unlike the 2017's bill, which passed just days before year end. So what does this mean for strategy? For starters, with rates staying put, Roth conversions are no longer a race against the clock. Retirees will no longer see big tax savings from converting, say, in the 22% bracket now, and then post-2025 being able to save money in the same bracket, which would now be taxed at 25%. Instead, with this permanent change, the tax planning game really comes down to optimizing your personal situation. We also get a temporary bump in the standard deduction from 2025 to 2028. $1,500 for individuals and $2,000 for married couples. After that, the deduction reverts to the permanently doubled base, indexed for inflation. These next 4 years may be some very favorable planning windows. For those 65 and older, there's another bonus, a new temporary deduction of $4,000 per person from 2025 to 2028. This stacks on top of the usual over 65 standard deduction add-on. This brings the total standard deduction for a married couple over 65 up by $10,000 to a whopping $43,200. But, and it's a big but, the deduction phases out at $75,000 for a single person and $150,000 for a married couple. The important part here is it's not a gradual taper. It appears right now to be a cliff. Go even $1 over and lose that entire $4,000 or $8,000 deduction. So this creates a really tricky planning situation similar to IRMAA brackets. For some retirees, you'll want to keep your income just under that threshold. For others, you may want to aim to shoot well above it because minimizing tax issues down the road is more important. The middle ground, well, tax cliffs create no middle ground. The last thing you want to do is go over that income threshold by $1,000 and lose $8,000 in deductions. Next up, the estate tax. Under current law, the exemption is set to drop in half in 2026. This bill changes that, making the exemption permanent at $15 million per person or $30 million per couple. That's indexed for inflation going forward. This gives wealthier families more breathing room and removes the urgency to push gifts before a hard deadline. If you've already been planning for this drop, well, great. If not, now you have more runway. Either way, we have clarity here, assuming that this bill passes as is. There's also a change to the SALT deduction, that's state and local tax deductions. Right now, the deduction is capped at $10,000. This bill raises it to $40,000 for 2025, which is a win for people in high tax states if they itemize their deductions. But here's the catch. This cap starts to phase down once your income crosses $500,000 and high earners in the top tax bracket can only deduct SALT at a reduced rate. Plus, if you're in a service business using a pass-through entity to get around the SALT cap, those strategies are mostly going to be shut down. So it's more generous for most, but still limited for top earners. This bill gives HSAs a serious upgrade. Here's what's new. People on Medicare Part A can now contribute to HSAs if they also are in a high deductible plan. This opens the door for those working past 65 to still be able to contribute to an HSA without worried about how Medicare Part A affects this eligibility. All bronze and catastrophic plans from ACA will be HSA eligible, whereas right now only a portion might be. You will also be able to use HSA funds for a broader list of preventative services and wellness expenses, which is a no-brainer win in my opinion. Couples can make the catch-up contributions now to a shared HSA rather than just having to separate them out like they do right now. For instance, right now you need to have 2 HSAs to each make a catch-up contribution. And because of this, many miss out on one spouse's catch-up contribution. This will change that. Unused FSA and HRAs can now be converted into HSAs once per year. Right now, these are funds that if you don't use, you lose. Again, an overall win for HSAs. Then finally, households with lower incomes will be allowed higher contribution limits. All of these changes are going to supercharge one of the most tax-efficient savings vehicles around. Now, during campaign season, we heard a lot about eliminating taxes on tips, overtime work, and even Social Security income. This bill follows through with the first two. No more tax on tips or overtime, which could benefit part-time workers and phased retirees. As for Social Security, this still remains taxable. I've personally been of the opinion that tax-free Social Security is unlikely, and the fact that it wasn't included in this bill leads me to discount the likelihood of future tax-free Social Security even further. Next, this might be the second biggest planning insight for retirees inside of this bill. Right now, ACA subsidies are quite forgiving. You can make 6 figures worth of income and still qualify for hundreds of dollars per month in lower premiums and lower annual deductibles. But the provision is set to expire at the end of 2025. This bill does not extend it. Starting in 2026, the old subsidy cliff returns. For a married couple, go even $1 over around $85,000 in income and you lose thousands in health insurance subsidies for that year. This turns healthcare planning into a tax strategy exercise and one of the biggest planning hurdles for those retiring before 65. This bill will go even further than this, however. This bill reinstates full clawbacks of excess subsidies that you might receive. If you underreport income and get too much help, you pay back every cent. Right now, there are caps to how much you have to pay back. Also eliminated are income-based special enrollment subsidies. Basically, if you qualify for a special enrollment period mid-year based on low income, you will be ineligible to earn any subsidy for that year. Finally, you'll face tighter verification rules for income and identity. Basically, if you're retiring before 65 and using ACA, these rules make annual income calibration more important than ever. Now, to balance a lot of these tax cuts, this bill introduces some spending reductions as well. Here are the 3 main areas. Permanent repeal of deductions for personal exemptions, investment advisory fees, moving expenses, and more. Elimination of most climate-related tax credits for solar panels, electric vehicles, energy-efficient home upgrades, and more. Tighter eligibility for ACA and Medicare access, particularly for undocumented immigrants. Now, these spending cuts are meant to help the bill meet these reconciliation rules. But whether they truly offset the cost is an economic model question and seems to be left up to whose assumptions we are actually using. From a planning standpoint, most of these cuts won't materially affect well-positioned retirees, but they're still worth understanding. This bill, if passed, will have some massive implications for retirees. I think the likelihood of certain aspects of this bill passing, like the tax cuts extension, are very likely and would be my base case. Other parts of the bill, we will just have to see how they change before an eventual bill is passed. Either way, we are likely to see some big shifts to tax planning and certainly some added complexities. If you like this video and want to dive deeper into the weeds on retirement planning topics, I've got 2 videos right here that you might like. Up top, we dive into why tax-free Social Security is quite unlikely. The bottom video dives deeper into Roth conversion planning and talks about 6 situations where Roth conversions actually don't make sense for your situation. Click on either of these to learn more, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.